Let me start with a thought experiment that will make you uncomfortable, because it should. Imagine two traders. Trader A has a mediocre trading system, nothing special. Maybe it wins 52% of the time. But this trader has iron discipline. Every single trade follows the plan. Every loss is cut at exactly the right point. Every winner is managed perfectly. No exceptions, ever. Trader B has a brilliant system, back-tested, optimized, wins 65% of the time when followed correctly. But this trader can't stick to it. Sometimes they cut winners short because they're scared. Sometimes they hold losers too long because they're hoping. Sometimes they skip trades. Sometimes they overtrade. Who do you think makes money? If you said Trader A, you're right. And here's the part that's going to sting. You're probably Trader B. The uncomfortable truth that nobody wants to hear is this: your strategy probably works. It's not your strategy that's failing. It's you. You're not following it. And every time you deviate, every time you make an emotional decision, every time you say just this once, you're destroying any edge you might have had. Today, we're going to talk about why discipline beats strategy every single time. And more importantly, we're going to talk about how to build the kind of discipline that actually makes you money. Here's the paradox that destroys most traders. We spend 90% of our time looking for better strategies, and maybe 10% of our time on discipline. But the reality is exactly backwards. Strategy matters about 10%. Discipline matters about 90%. Let me explain why. Trading is a game of probabilities played over many, many repetitions. Your edge, whatever gives you an advantage, only reveals itself across dozens or hundreds of trades. One trade means nothing. 10 trades mean almost nothing. But 100 trades? Now we're starting to see the truth. If you have a system that wins 60% of the time with proper risk-reward ratios, you will make money over time. Mathematically, you must, but, and this is massive, only if you follow it consistently every single time, no exceptions. The moment you start making emotional decisions, you destroy the math. You hold a loser because you're hoping. That one trade ruins the risk-reward ratio of 5 winners. You skip a trade because you're scared after a loss. That trade would have been a winner. You double your position size because you're feeling confident. You lose, and now you're down twice as much as your plan allowed. This is what I call the consistency gap. The gap between knowing what you should do and actually doing it. And this gap is where most traders bleed money. Let me tell you about a trader I know. We'll call him James. James had been trading for 3 years. He'd spent thousands on courses, read dozens of books, tested multiple systems. He finally found a strategy that worked. He back-tested it. It won 58% of the time with a 2-to-1 risk-reward ratio. The math was clear. He should make money. But 6 months later, James was down 30%. How? When I looked at his journal, the answer was obvious. He was strategy hopping. He'd take 3 losses in a row, completely normal for a 58% win rate system, and decide the strategy was broken. He'd switch to something else, then that would have a few losses. Switch again. He was never in any system long enough for the edge to reveal itself. This is the strategy hopper. And if you're honest with yourself, you might recognize this pattern. One week you're trading breakouts. Next week you're trading mean reversion. Then you read about volume profile, and now you're completely restructuring everything, and you're not giving anything time to work. Mark Douglas, in his book Trading in the Zone, explained what he called the 5 fundamental truths of trading. And these truths are what separate disciplined traders from everyone else. Truth 1, anything can happen. Any single trade can be a winner or a loser, regardless of how good your analysis is. Truth 2, you don't need to know what's going to happen next to make money. You just need an edge that plays out over many trades. Truth 3, there is a random distribution between wins and losses for any given set of variables that define an edge. You could have 5 winners in a row or 5 losers in a row, and both are completely normal. Truth 4, an edge is nothing more than an indication of a higher probability of one thing happening over another. Truth 5, every moment in the market is unique, but patterns do repeat with enough similarity that they create edges we can exploit. When you truly internalize these truths, you develop what Douglas called a probability mindset. You stop caring about any individual trade. You stop trying to be right. You just execute your system, manage your risk, and let the math work over time. But here's where most traders fail. They understand this intellectually, but they don't believe it emotionally. So when they have 3 losses in a row, panic overrides logic. When they have 3 wins in a row, overconfidence overrides logic. Every emotional decision you make negates your edge instantly because your edge is mathematical. It's statistical. It only works when you follow the rules that create the statistics. The moment you deviate, you're no longer trading your system, you're gambling. So how do you build discipline? You start with a plan so specific, so detailed, that there's no room for emotion to sneak in, no room for interpretation, no room for I think or I feel. Let me break down what a real trading plan looks like. Not the vague, general nonsense most people write. I mean specific, measurable, objective criteria that a robot could follow. First, entry criteria. This needs to be completely objective. When the price looks good is not a plan. When I feel confident is not a plan. Here's what a real entry criteria looks like. I enter long when the 20-period EMA crosses above the 50-period EMA on the daily chart. The RSI is between 40 and 60. Volume on the crossover day is at least 20% above the 10-day average, and price is above the 200-day moving average. See the difference? There's no interpretation needed. Either all conditions are met or they're not. You take the trade or you don't. Your emotions are irrelevant. Second, exit criteria. And this means both profits and losses defined before you enter the trade. Your stop loss should be based on technical structure, not on how much money you're willing to lose. Maybe it's below the recent swing low. Maybe it's below a support level. Maybe it's at a percentage of ATR, but it's defined before entry, and it never moves further from entry, ever. Your profit target should also be defined. Maybe it's a fixed risk-reward ratio. Maybe it's a trailing stop. Maybe it's when price reaches a major resistance level. But you decide before entry, not while you're in the trade watching every tick and feeling emotional about it. Third, position sizing rules. This is always a fixed percentage of your account. Always. Not, I feel good about this one, so I'll go bigger. Not, I'm down this week, so I need to make it back. A fixed percentage, 1%, 2%, whatever you decide. But it's the same for every single trade. Let me be brutally clear about this. If you're varying your position size based on how confident you feel, you're gambling. Confidence is not an edge. Confidence is an emotion, and emotions destroy accounts. Fourth, risk management parameters. You need maximum loss limits. Maybe it's a maximum daily loss. If you lose 2% of your account in one day, you stop trading for the day. Maybe it's a maximum position size. You never risk more than 2% on any single trade. Maybe it's a maximum number of open positions. You never have more than 3 trades open at once. These parameters protect you from yourself. From revenge trading after a loss, from over-leveraging when you're feeling invincible, from the emotional spirals that destroy accounts. Fifth, trading schedule. When you trade, and just as importantly, when you don't. Maybe you only trade during specific market hours. Maybe you only trade on certain days. Maybe you have rules about not trading after big news events. Maybe you have rules about not trading after you've had 2 losses in a day. The point is, you decide when you're in the right frame of mind to execute your plan, and you only trade during those times. Sixth, market conditions filter. What environments do you avoid? Maybe you don't trade when volatility is extremely low. Maybe you don't trade when there's major news expected. Maybe you don't trade during earnings season. Maybe your strategy is designed for trending markets and you have a filter to identify when the market is choppy. You need to know when to stay out because not trading is a position, and sometimes it's the best position. Seventh, performance review schedule. At minimum, weekly. You need to review every trade you took and every trade you should have taken but didn't. You need to score yourself on adherence to your plan, not on outcomes, on process. Did you follow your entry rules? Did you follow your exit rules? Did you stick to your position sizing? Did you let emotions override your plan at any point? Let me give you an example of how this all comes together. Let's say you're a swing trader focusing on momentum plays in stocks. Your complete plan might look like this. Entry criteria. I enter long when a stock breaks above a consolidation pattern that lasted at least 10 days. Volume on the breakout day is at least 50% above average. The stock is on my watch list of fundamentally strong companies, and the broader market is in an uptrend as confirmed by the S&P 500 being above its 50-day moving average. Exit criteria, stop loss is placed at 1 ATR below the consolidation pattern. Initial profit target is 2 ATR above entry. If price reaches 1.5 ATR in profit, I move my stop to break even. If price reaches 2.5 ATR in profit, I trail my stop at 1 ATR below the highest high. Position sizing, I risk exactly 1% of my account on every trade. Position size is calculated by taking 1% of account value divided by the distance between entry and stop loss. Risk management, maximum 3 open positions at any time. Maximum daily loss of 2%. If reached, I close my platform and don't look at markets for the rest of the day. Maximum weekly loss of 5%. If reached, I don't trade for the rest of the week. Trading schedule. I scan for setups after market close. I place orders before market open or within the first 30 minutes of trading. I don't monitor positions intraday unless I'm adjusting stops based on my rules. I don't trade on FOMC days or during the week of major earnings for positions I'm holding. Market conditions. I don't take new trades when the VIX is above 35 or below 10. I don't trade during the last week of December or the first week of January. Performance review. Every Sunday, I review the week's trades. I score myself 1 to 10 on plan adherence for each trade. I note any emotional decisions or rule violations. I look for patterns in my mistakes. This is a plan. Specific, measurable, objective, no room for interpretation. You either follow it or you don't. And that's the point. So you have a plan. Now comes the hard part, actually following it. How do you build the discipline to execute consistently? First, your trading journal is your accountability partner. And I don't mean just recording trades. I mean recording everything. How you felt before the trade, whether you followed your rules, what emotions you experienced during the trade, what you were thinking when you exited. The journal makes patterns visible. You'll start to see that you always overtrade after losses, or that you always exit winners too early on Fridays, or that you always skip your best setups when you're on a winning streak because you're afraid of giving back profits. Once you see the pattern, you can address it. Second, the pre-trade checklist. Before you enter any trade, you go through a checklist every single time. Never skip it, even when you're 100% sure you've checked everything. The checklist might look like this. Does this meet all my entry criteria? Yes or no? Have I calculated position size correctly? Yes or no? Have I placed my stop loss according to my rules? Yes or no? Have I set my initial target? Yes or no? Am I within my maximum position limits? Yes or no? If there's a single no, you don't take the trade. No exceptions. Third, automate wherever possible. Set price alerts instead of watching the screen. Use bracket orders with automatic stops and targets instead of mental stops. Use trade management software that enforces your position sizing rules. The more you can remove manual decision-making in the moment, the less opportunity for emotions to hijack your plan. Fourth, the daily routine. Same actions, same time, every single day. Consistency breeds discipline. Maybe your routine looks like this. Review open positions at 9 a.m., check for new setups at 9:30 a.m., place orders if setups meet criteria. Close your platform at 10 a.m., check again at 3:30 p.m. for exit management. Close platform at 4 p.m. Review the day in your journal at 8 p.m. Same routine, every day, no exceptions. This removes decision fatigue. You're not deciding whether to check the markets. You're not deciding when to do your analysis. It's automatic. Fifth, reward adherence to process, not outcomes. This is critical. You had a losing trade, but you followed your plan perfectly. That's a win. Celebrate it. You had a winning trade, but you exited based on fear instead of your rules. That's a loss. Note it as a failure. You're training yourself to value discipline over dollars, because in the long run, discipline creates the dollars. Sixth, the power of small, consistent wins. Don't try to build perfect discipline overnight. Start with one rule. Maybe it's, I will always calculate position size before entering. Just that one rule. Master it for 2 weeks. Then add the next rule. Small, consistent wins compound into unbreakable discipline. Here's the truth nobody wants to hear. Your brain will always try to make you deviate from your plan. Always. It's designed that way. When you're losing, it will tell you to risk more to make it back. When you're winning, it will tell you to risk more because you're hot. When you see a setup, it will tell you this one is special. You can skip the checklist just this once. Your brain is not your ally in trading. It's your enemy. The solution is to make your plan so clear, so specific, so objective that there's no room for your brain to insert interpretation. There's no room for I think or I feel. There's only the criteria are met or the criteria are not met. And then you follow the plan. Every time, no exceptions, even when it feels wrong, even when you're sure this time is different, especially then, because your edge isn't in your strategy. Your edge is in your ability to execute consistently over time. That's it. That's the whole game. So here's your challenge. For the next 20 trades, score yourself on discipline, 1 to 10. How well did you follow your plan? Not how profitable was the trade. How disciplined were you? If you're scoring 8 or above on every trade, you're going to make it. If you're not, you know exactly where the work needs to be done. The market doesn't care about your excuses. It doesn't care how much you know. It doesn't care how good your strategy is on paper. It only cares whether you can execute consistently, day after day, trade after trade, win or lose. That's discipline. And that's what separates the 10% who make it from the 90% who don't. If you found value in this video, hit that subscribe button because we're going deep on the psychology and mechanics of profitable trading. No fluff, no get-rich-quick nonsense, just the hard truths that separate professionals from gamblers. Drop a comment below and tell me, what's the one rule you break most often? Be honest, because once you name it, you can fix it. Remember, the market doesn't reward the smartest traders. It rewards the most disciplined ones. I'll see you in the next video. Now go build that discipline.